All right, let's just dive right into this. Welcome back to another explainer. Today, we're unpacking an absolutely fascinating puzzle surrounding one of Asia's largest, most influential life and health insurance titans, AIA Group. Look, if you've ever stared at a stock market chart and thought, okay, this makes zero sense, well, this one is definitely for you. A week ago, AIA reported their interim results for the first half of 2026. And by almost every single measure, those results weren't just good, they were completely record-breaking. We're talking all-time highs in the metrics that actually matter. But as we're going to see today, the market's reaction has created a massive, glaring disconnect. So we're going to use the hard data and the analyst reports to break down exactly what is happening under the hood of this financial giant. To really wrap our heads around the sheer scale of AI's recent success, you just need to look at one number: $3.6 billion. That is the amount of capital AI returned directly to its shareholders in just the first 6 months of 2026. And this wasn't done through some clever accounting magic. We are talking cold, hard cash, distributed through dividends and share buybacks. When a company returns that kind of money in just half a year, it sends a crystal clear signal to the market. They are generating massive amounts of cash, and they're confident enough in their balance sheet to just hand a huge chunk of it right back to investors.
But here is where things get weird. If earnings are hitting all-time highs and the company is literally showering investors with billions in buybacks and dividends, why on earth is the stock lagging so far behind? Right now, it's trading nearly 20% below its 52-week high, basically scraping the bottom of its recent trading range. It's a huge contradiction. On paper, they are hitting grand slams, but on the ticker tape, they are striking out. So why the disconnect? Let's follow the clues, starting with a closer look at those incredible earnings.
Part 1. The record-breaking earnings. What's truly incredible here is that there is absolutely zero weakness to be found. Just look at these double-digit growth figures across the board. First, we've got the value of new business, or VONB. If you know insurance, you know this is the ultimate growth metric, and AIA hit a record high of $3.212 billion. Next, operating profit after tax came in at $4.163 billion, which is a 13% jump that actually beat consensus estimates. They're generating incredible cash with net free surplus up 12%, and because of that, they bumped the dividend by 10% to 53.90 Hong Kong cents. The bottom line? Net profit attributable to shareholders literally skyrocketed by nearly 70% to almost $4.3 billion. The management team even upgraded their future guidance based on these numbers.
And it's not just revenue either. AIA is becoming significantly more efficient at making money. In 2025, their operating return on equity was sitting at a very respectable 15.5%, but in the first half of 2026, that number accelerated to a record 17.5%. The underlying engine of this company is running hotter and more efficiently than ever before. So clearly the financials are bulletproof. The problem isn't inside the building. The problem is outside.
Part 2. The price disconnect.
So, as of August 27, 2026, AIA's stock is sitting right at 74.65 Hong Kong dollars. Now, to put that into perspective, their 52-week trading range is 68.95 at the very bottom and 92.15 at the top. So, despite the record-breaking profits, despite the upgraded guidance, and despite the billions in buybacks, the stock is trapped near the absolute floor of its yearly range. I mean, it barely even moved on the day these incredible earnings were announced.
Let's untangle this chaotic timeline to pinpoint exactly when and why the market went into a panic. August actually started off pretty normal, but then on August 6th, the floor just fell out. The stock plummeted 8% in a single day. The trigger was a piece of tax news, which we're going to dive into deeply in just a second. After that initial shock, the stock tried to recover, rallying over 4% on August 17th as investors anticipated the upcoming earnings report. But when those stellar earnings actually dropped on August 20th, the stock didn't soar. It actually fell slightly to 72.75, mostly because that record VONB number was just a hair below a few highly optimistic analyst estimates. Since then, it's just kind of limped back to 74.65. The shadow of that August 6th drop is clearly overpowering the reality of the August 20th earnings.
Part 3. The Wall Street Consensus.
The really crucial point here is that Wall Street is overwhelmingly bullish. You've got major firms like Jefferies, DBS, UBS, and UOB all screaming buy, with consensus targets implying a massive 40% upside from where the stock sits today. They are looking at the fundamentals and seeing a hugely undervalued asset. But there's a lone cautious outlier here, HSBC. They downgraded their target to 74 with a hold rating. So why is HSBC hitting the brakes while everyone else is slamming the gas?
Part 4. The China tax wildcard.
Going back to August 6th, Caixin, which is a highly respected Chinese business publication, dropped a total bombshell. They reported that tax authorities in Beijing and Hangzhou had started actively applying a 20% personal income tax on returns generated from Hong Kong insurance policies. This includes things like dividend payouts and the interest earned on prepaid premiums. Well, this report sent absolute shockwaves through the market. It didn't just tank AIA, it dragged down their rival Prudential by over 5% and pulled the entire Hang Seng Index lower.
To understand why this is such a big deal, we need to quickly break down the mechanics of AIA's business model. Step 1. Mainland Chinese buyers are a massive driver of AIA's new business. They buy Hong Kong insurance policies to access offshore yields, multi-currency flexibility, and honestly, just better protection than domestic products offer. Step 2. If tax authorities suddenly enforce a 20% haircut on those yields, the attractiveness of those offshore policies takes a very serious hit. Which leads to step 3, the ultimate fear. Investors are terrified that demand from mainland visitors will drop, forcing Hong Kong insurers to change their product structures, which will inevitably compress those beautiful profit margins we were talking about earlier.
But wait, here's the absolute aha moment of this whole situation. On August 7th, the day after the crash, China's State Taxation Administration clarified things. They put out a statement reminding the public that overseas income must be taxed according to law. The big revelation? This is not a new policy. This 20% tax rule has literally existed since the implementation of China's personal income tax law. The rule itself hasn't changed. What's changed is just the strict enforcement of that existing law in certain cities.
And that little piece of nuance, it has triggered a massive debate in the financial world. On one side, analysts from firms like Citi view that August 6th sell-off as a temporary, panic-driven overreaction. They argue that the core reasons mainlanders buy these policies, asset diversification and currency flexibility, those are totally intact, tax or no tax. But on the other side, experts like Zhang Jiwei at Bayan Capital, along with HSBC, warn that this strengthened enforcement represents a real structural shift. They believe it's going to inevitably dampen mainland clients' willingness to cross the border and buy these policies going forward.
Part 5. Bull versus Bear Outlook.
So let's weigh this out. The bull case for AIA is historic and structural. I mean, they are the #1 million-dollar roundtable multinational company globally, and they've held that title for 12 consecutive years. Their premier agency just grew VONB by 11%. Plus, they operate across 17 markets in the Asia-Pacific region, which CEO Li Yuanxiang rightfully calls the most compelling growth opportunity for life and health insurance in the world. But you absolutely cannot ignore the bear case. Strict tax enforcement could definitely dampen that crucial mainland demand. Combine that with intensified competition in Hong Kong and potential margin pressure, and you really have to ask if trading at a 12.4x price-to-earnings ratio properly prices in that level of risk. Which brings us to our final question, and I want to throw this paradox right back to you. We've seen the record-breaking numbers, the billions in buybacks, and the consensus 40% upside from Wall Street. But we've also seen the undeniable risk that strict tax enforcement poses to their most lucrative customer base. So based on all the data, what's your verdict? Is this temporary panic creating a massive buying opportunity? Or is this the beginning of a structural shift with even more downside to come? I would love to hear how you weigh the facts, so let me know what you think. Thanks for joining me for this explainer, and as always, keep questioning the numbers.